Foliko Live. It is Wednesday, September 7th, and we are joining you here live. My name is Travis Nixon. I'm a career data scientist joined by Tyler Tucci, a former hedge fund PM and now current head of research for Cinerai. Today, a lot of interesting things happening in the market. Tyler, good morning. How are you?
Morning. I'm doing pretty well. We absolutely smashed that natural gas short. I mean, what more can I say? I mean, that was quite good. If you were inclined, our Neo call pretty good, pretty bad, pretty good again. We got the earnings miss and the reaction we were looking for, but you had about 45 seconds to cover on the open before a 5% push. There was a nice reshort opportunity there, but I mean, unfortunately, we kind of only get a B on that. You know, the trade was there. We were long the puts, 1750 starting Monday. So there was $1.50 of adverse movement for longs, $1.50 for us. So the window was open to make, to profit, but because it didn't fall and stick, we can't really celebrate in the same way, if that makes sense.
Yep. Yeah, so they had a miss of about 10% on EPS, but a beat on revenue. And that mixed message right there is kind of tossing the market up in a weird way. But you had the opportunity. You had the opportunity to make it out with your money.
Right.
Yeah. So what does that say for future earnings calls? Does that mean you should have some automatic limits set in?
Yeah, and this is what we've been talking about and exploring is we have an edge, in our opinion, over the discrete event. So the minute earnings is behind you, you no longer have as large of an edge. So you should be, dumping. You should be removing the position because the edge has started to shrink because our view is just over earnings specifically. So yes, I mean that is something that we will continue to work on. So we can just say, okay, have it down to something that's as simple as okay at market opens 8:30 Central here at 8:37 is the optimal time to exit these earning trades. So we're working towards giving you a systematized exit because if we can get you in, we better get you out.
Now, there are certain triggers to say yes or no, like Jack Henry, if you recall, on the open, it was wrong, but then it healed and actually went our way in a little bit. Should you have different thresholds depending on how much you've made to that point?
Yes, that's called trailing a stop. Yes, there's different ways to manage that risk, but there's certainly within your framework, and that's why I like Foliko's stuff. You just apply it within your framework, right? So if you noticed on Neo, I believe it was Neo bounced right off of the 8-day exponential moving average. So within the context of your system, say if you're an EMA cross trader, you can say, okay, I want to reshort this name, and you bring in your level and your technical analysis, but then you also use the scanner of Foliko to execute and enter the trade and find these trades. So that's kind of the way that should have worked in my opinion.
So now I want to dive into what you said about your natural gas short. Talk to us about that. What's happening there?
So it's interesting because this one to me was so painfully obvious. I believe it was 2 Fridays ago. I think it was The Economist had a cover about the pending energy crisis in Europe and how everyone's going to freeze and starve. And generally, by the time that stuff gets to the front page, it's over. And you don't need any advanced degree for that. You don't need trading sentiment is one of my favorite things to do, and I wouldn't say it's easy because you are always in the positions against consensus, right? So you're against your friend, you're telling your friends their Bitcoin positions are all worthless, at 65. Like you're doing all this stuff that you have to go counter to what the common knowledge game is.
Well, you're always the asshole in the room. Everyone's celebrating. And you're like, oh, you guys are idiots. You're always the guy like, no, yes, but.
Right. And there's ways to do that, right? Because there's a lot of contrarians who don't last long because timing is of the utmost importance. You have to both have the thesis of short natural gas and the trigger of, okay, there's not one buyer on the planet left, right? Like this is all the way priced in. This is as much as, and those are the best trades. And off the back of that, for example, I went into Foliko and I found some natural gas names, CTRA and SWN. I'm currently long CTRA puts. And that's kind of how I use Foliko, just as kind of, my own experience. But yeah, I mean,
holding that.
this is I have a target for natural gas. I have a target for CTRA, and I'm kind of hoping that they coincide with each other. If one gets there first, I might take the other one off, if that makes sense, because I'm either missing something or, there's been a bit of a dislocation. But, pretty good, looking to press. Rolled a lot of the position. I'm well into the red zone on this. So basically the last 20% of this position is going to be some degenerate gambling looking for another nasty leg down. I've already chopped the wood pretty much. But that to me those are all my favorite trades, is the ones that in hindsight are so obvious. And the more you look at this and the more you do this, the more they become obvious in advance. You can just go to newsstands don't exist anymore, but a virtual newsstand and look at the covers and be like, okay, so like, what does everybody think? What is completely priced in? Okay, so now what? What are the weird outcomes we can get from there? What are the weird tails we can get there? I mean, one of them is natural gas down like 20% on a rope, right? Because we're just out of buyers, and all the fear and pessimism is completely priced in, which sells, by the way. So it's in their interest to say crazy, and everybody's guilty of it. You embellish. We like hyperbole, but that's it's a job. You have to sell newspaper, whatever. You have to sell publications, whatever it is. So
now, if I'm thinking though, what is next, right? So natural gas, you've hit that. That's great. What is next for everybody views the market in a certain way? I've got to say, the big hypothesis I'm seeing out there is housing is crashing.
Yes.
And so the biggest surprise to this market right now would be if housing continues to climb.
And I'll start to lay out this case, and then I'll bring you some charts in the next couple of weeks. But in 2008, places like Canada and a bunch of other like G8 housing markets basically just dipped and ripped. And if you look at a chart, 08 over there was just kind of this. I kind of think that there's similarly to not being a natural gas contrarian, I think, what if this is just a small dip? And that kind of brings us to our we hit a bottom in September kind of thesis, where, I can't imagine stocks perform tragically if the housing market is appreciating, say, even something moderate, whatever, 5-6% per annum. It's just kind of a slow grind higher, as opposed to the completely, dislocated, slap happy powerlifting that happened during COVID as everybody fled cities. A bit more slow and deliberate. But yeah, I mean, that's kind of my operating thesis, and that will be our alternative hypothesis when we finally do the Cinerai quant on housing. We're gonna have to figure out what questions we want to answer with data, to put it in your words. But yes, I mean, that's exactly going to be something that we're going to look at, because it's got huge ramifications. And again, I always say this: I may not always be right, but you'll always be wrong. It's really, playing the man is way easier than playing the board.
I have a theory about housing.
Okay.
And this is going to sound, all right, go with me a few steps, because this is some data analysis I've been doing in preparation for our upcoming Cinerai quant, but I'm going to tease this out. I think that we can pin a lot of the future of the housing market as to what Progressive Insurance, the company, does over the following couple months with their workforce. So step with me on this. Have you ever heard of the Cincinnati theory?
No.
The Cincinnati theory is that most brands around the world, around in the US, test their products first in Cincinnati, Ohio, because Cincinnati, Ohio is the median city of the United States. It's big enough to matter. It's small enough to still have rural population. And everyone there is almost exactly average for income, for I think there's just a whole stack of measures as to why Cincinnati is the perfect test bed for most of your products to see how they're going to perform, right? And you'd think, oh, Cincinnati, what a boring city. They are one of the first people to get rollouts of almost every technology, cell phones, 5G service, all this kinds of stuff. If you're in Cincinnati, you get stuff like a month, 2 months, 6 months before everyone else, right? You also see really weird stuff, like Wendy's was testing like chili burgers for a while in Cincinnati, Ohio, or it was some. You always get like weird food, and so anytime I would visit that, and I worked with some customers out in Ohio, not necessarily in Cincinnati, but you get the weirdest food in the restaurants there. Progressive Insurance is headquartered in Cuyahoga County, Ohio, right? So Mayfield Village. Progressive is determining right now that they want to start bringing their workers back into the office. I think housing and the future of housing, I remember on our last Foliko Live, I painted for you a dichotomy of two different paths that this could go down. Either first, all these cities that have been depleted of workers are going to call the workers home, and those cities are going to repair their housing markets. And cities like Boise and Las Vegas are really going to die in their housing prices. Or second, those companies are going to capitulate, and all the holders of investments in areas like California and New York are going to realize that they're never going to get their return. They're going to try to sell it and get rid of it all. And there's going to be a massive housing drop in those areas. So I think that we're going to see a dichotomy of housing appreciation and housing drops, and it's going to be regionally affiliated. But I think that that whole war can be determined by how the return to work happens at Progressive, being the most prototypical company in the most prototypical spot of the country. That's my thesis. If you want to know the future of the housing market, watch Progressive Insurance and how their return to work operates.
I like that a lot. That's very interesting. Yeah. That would make a lot of sense. And that is, to that point, that is the next shoe to drop, is if nobody's coming back to the office, things are going to change very quickly. New York City rents all of a sudden become what? And that's the question.
They're still sitting at like 20% office capacity being used right now, but investors are still all gung ho and just fine with the investment and building new development and stuff like that. My light just went out. On the excuse that workers will return.
Right.
As soon as we realize that's never going to happen again, the entire landscape changes. Let me get this light back on.
But yes, that's exactly the case. Is there are a lot of office buildings that have rent agreements rolling off very soon, and there's a very wide range of outcomes where, in some places there is going to be you'll be able to get 20% more. You'll sign 5-year leases at 20% more in some locations where they are coming back to work in the office.
Well, you think about the big tech companies, Google, Amazon, they have huge contracts with local municipalities saying that we will bring X number of jobs to this city, and in return, we will get X tax cut. They are currently in violation of those agreements because of the remote work. And so a lot of these companies like Google saying, well, you still have to be in the office once a week. They're building models to determine that a number of workers are going to be in the city in order for them to fulfill their municipal agreements. As soon as those companies renegotiate those because they realize they can save more money with remote work than with these tax cuts, all bets are off. Then it's done.
So to that point, AI-powered swing trader wants to know, what's the investment play if work from home progressive theory predicts the housing market? Well, it depends.
That's not official now. Progressive theory.
I like that.
Oh,
The Travis Nixon progressive theory. It really depends on what the data say. One outcome might be shorting. I believe it's Vornado who just does. There's a couple just New York City REITs. Those probably become shorts if we decide that nobody's coming back to the office. That's the fastest one that jumps off the top of my head. If we do find that Progressive is relenting and letting people stay at home, then maybe you do it. But that's the one that pops into mind. Otherwise, it's just going to be XHB is the ETF.
You have people like NVR, though. NVR being the biggest home builder in the country.
Right.
I would be very bullish on NVR because they build in suburban locations where it's easy to get out to this more rural area and work from home. They also have a focus on at-home office building and stuff like that. So some of these real estate development companies, I think that's a great bet. Not a financial advisor, but if the progressive work from home push doesn't go well and you see them start to ease on that language, then I think NVR would be a good purchase. Something that I would add more medium term, midterm into my portfolio. We are underhoused in the US. When you compare us to the UK and Canada and things like that, uh, our houses built per person are still far below where they could be. So I don't see a massive housing fall happening. I see this regional shift happening. And if you can bet on rural versus urban, that's the bet.
Yes, and
NPR is your rural bet.
the sprinkle on top will be, what do you think of mortgage rates? Because it's much more complicated now to sell your house where your mortgage is 3.5, 4, and then you have to go extend at 6, 7. That's a meaningful amount. So that's kind of that'll be the kind of the last wobbly Jenga piece is the rate component, as it always is in everything, in my opinion.
And I tell you what could really rock the economy: rent never falls. That's the adage, right? And that's what was printed in The Economist. Rent never falls. If we got to a point like we're talking about in New York and California, rent will fall, and that causes a whole domino effect of problems in those areas because you
Yes,
have
and
investments that are no longer able to be met on that.
there's a thesis by a gentleman whose research I read, and he's basically compared the what happened in 2016 in Texas and in the Dakotas to what's going on right now in Silicon Valley, where basically it's kind of the end of the road for version 1, where it's just growth at any price, everybody gets green juice, all this, we have all these perks, because really at the end of the day, those big tech companies were like, here, check out these scooters. And everyone there was like, but more money. And they're like, here, look, we got you a gym. And they're like, but more money. And this is kind of where the rubber hits the road, where you're paying for talent only. You have to cut back on all the rest of the good stuff. And now we are going to see, there will be winners and losers now. Just like in 2000, where some companies died and shriveled up and it was the end of them. But some of these companies are great companies and going to be incredible buys. Over, they're gonna make you hold it, right? 3 to 5 year kind of deal to get 600% upside on the equity or something aggressive like that. But that's we're the rubber is hitting the road in tech. I know that's this is coming from an outsider as somebody who does it. Is that kind of the sentiment there?
Yeah, I think so. What's happening in tech is really interesting. Monetizing eyeballs. We've talked about that, right? Have you noticed this trend in tech that we're getting away from monetizing eyeballs and everyone's going towards alternative forms of monetization?
Right. Eyeballs don't spend any money.
Yeah. Well, if you look, one of the biggest trends that we're seeing is that the biggest eyeball monetizers, growth wise, is Amazon and Apple in their own respective stores. So now companies are having to advertise on the location in which they sell their products. So that's going to be a lot more direct relationship with consumer piece that is going to be an evolving trend in that. That means folks like Meta and Google have really got to work hard to find alternative routes to monetization. Now, I'm excited about this. I'm excited because I think advertising has had too much of a role in our society. And I think that this is going to be a really healthy thing. And if you start paying for the things that you enjoy, that's going to be a much better relationship to make better things that you enjoy instead of finding ways to distract you better so that you now watch Why You Need Huggies instead of Love's Diapers. Sorry, phase of life I'm in. That's the daily choice. That's the big trend I see happening with tech. As far as the real estate, I don't think that's going to trickle down into tech too much, except they're going to be a leader in this remote work piece. I know every tech company in the world is trying to capitalize on that more and more and more. Meta has a huge work from home investment going on.
Makes sense. That seems to be what employees actually want. That's something that's actually attractive. You can get the exact same productivity from me, but I don't have to commute a million hours a week. And, I'm generally happier and healthier, which in my opinion are better employees, right? Like you function much better that way.
So Tyler, we've been talking about general market trends and things like that, and going forward on this iterative conversation, but I want to ask you, where are you looking for your next big play? The market is really kind of just crazy right now. Are you thinking let's just de-risk and hold and see the macro trends happening for a little while, or is there something really piquing your interest?
So the thing that stinks here, and by stinks I mean smells to me, is if you look at 10-year treasuries, you look at if you're just an equity only person, TLT, which is it's like a 20-year bond proxy. It basically has a similar duration of the 20-year bond. It's been for sale, and by that I mean there's been no buyers for 5 weeks. If you look at, I think it's again, restream, humble request. Please let me share 2 screens. I look like an idiot jumping around. But look at that. So that's the 1st of August. I mean, what can I say that already hasn't been said? It's bombed out and depleted. So that's the question, is whenever bonds do stuff like this, especially with the euro doing this, and by that I mean the euro doing this lower means the dollar is going higher. Yeah. Things usually break. This is the part of the game where the market goes and tries to find something so painful for global central banks that they tap out. This is the seek and destroy part of the game. I mean, if you look at dollar yen, 145, that's a 30% move against. I mean, the yen is like the risk off stable currency, and now they're lighting it on fire. So that's generally the thing that's kind of scaring me. And basically, by the time we find out the why, the market will have already bottomed. So the question is, what is the why here? Why is the dollar just ripping? Why are emerging markets? I mean, so look at this. This is the EEM ticker. Woof. Like, all of these non-dollar assets just stink. So that's the thing that concerns me, and that's why I can't. We have the market bottoming soon, and I still can't start to really lay out risk. I own a couple names, and I'm willing to fight for them, no matter how badly the market beats me. I don't plan to spit those up. But aside from that, there's no. You could call the bottom in bonds or the top in rates, bottom in bond prices. I'm not really ready to do that here at 10s are like 325. That's not, that's not. Pardon?
By the way, how's China looking?
Not that great, especially given expectations. I mean,
I saw so Wall Street Journal front page this morning. Was it front page? Anyway, they had 4 indexes up on the front page compared with the NYSE S&P 500, and the China's ETF was just dogging compared to everyone since June.
Yeah, I mean it's all terrible. It's all. I mean,
wow! Look at that! Look at that peak and that fall.
This is the JP Morgan Emerging Market Bonds ETF. Jeez. I mean, this is like
how much of this is the dollar and how much of this
is rates
happening.
Yes, this is there is no worse cocktail for. Well, this is dollar bonds, so the dollar part of this helped, but ripping higher rates in the U.S. is so bad for EM, especially the ones who are borrowing in dollars. And that's generally why it's bad for EM. So that's a concern. I mean, we're now down through COVID lows, right? Where we thought the world was ending. So it's getting very interesting out here. That's for sure. And I hate people who.
What's the next step, though? So we have this effect happening. You mentioned that we don't quite know the why. We're waiting to know the why. So what? But if this is the current domino that's falling, what is the next domino that hits because of this?
It depends. So the Fed, it looks like, leaked through one of their mouthpieces, they're going 75 bips next meeting.
Yeah.
just to make sure that
All right.
there is no breathing room.
What did I tell
Um,
you? This next round is a message round. It has nothing to do with numbers. It has nothing to do with anything except for next time we hope this bruise will still, show some marks so
right,
you'll believe us.
right. So that's the next thing. So they're going to go 75 basis points. We'll see what the market thinks about that. I mean, that puts the policy rate near at 4. They'll put 2-year rates near at kind of 4. And that becomes very interesting with 2-year notes at 4 and equities are here, and we're not that much off all-time highs. So that becomes the question: was this just kind of a really scary dip, or I mean, it's either 1,000 points up or 1,000 points down. And at the moment, I don't feel like I have an edge in calling either. Is basically how I feel.
This is a very, very strange market, it seems to me. Have we ever seen a market like this in the past?
No, and that's not to say I'm not saying this time is different, but the context in which the Fed is raising rates aggressively into is one that we haven't seen before, whereby the equity market was smoking hot, the housing market was smoking hot, and they jammed the brakes on all that, as opposed to when people talk back to Volcker, it's more, well, things were already bad and he burned the village to save it.
Are we finally seeing the chickens come home to roost on what seemed to be the monetary policy of the 2010s, which is debt doesn't matter? If you look at debt to GDP ratio, a lot of these currencies and countries where their debt has just gone sky high. I know we think that in the US we have a ton of debt, but it's nothing compared to China. It's nothing compared to Japan. Is this finally the capitulation that was needed to say that fiscal responsibility has to be a little bit stronger? Is there anyone, in other words, I guess the question to test this, are there any countries that were fiscally responsible that aren't running into the same mess? Germany, perhaps?
Well, but then they also have had the mercantilist benefits of an artificially weak currency, because they
they've run basically on exports for decades, right?
right, and they were allowed to price their currency at Greek levels, not German levels. So that was huge for them, and that's
okay.
And that's the interesting thing about, for example, in Japan, a majority of that debt is domestically owned. And there's a saying there, gosh, I can't believe I'm going to botch it. A rolling debt accrues no interest or something. Basically, like, if you can roll the debt, it doesn't default. So that's kind of the deal there, is it's all domestically held. So they can just kind of move it into different pockets and it's all good. The US is the one with a bunch of foreign holders that this starts to get interesting if we're borrowing at 5, 6, 7 instead of 2, 3, 4. So that's the thing that people talk about less frequently, is there is a number for the Fed that they just can't. I mean, things start to get really, really funky really, really quickly if they have to go to 8 and we have to borrow at 8 for a prolonged period of time to kill inflation. That's when all of this gets really, really curious. So that's the concern, and that's why I don't feel comfortable making a call that the euro is just going to completely fall out of bed and go from 0.99 to 0.9 or something. It's just I feel like all of this fear is already here, and now I'm just really trying to figure out what to do about it, because similarly, as I was talking about natural gas and it didn't continue going up on bullish news, I see nothing good here for stocks, and they're kind of hanging in, albeit at a much lower level than the bear squeeze level. But I don't see much progress being made, really. I mean, like, if you look at
For those of you watching at home, if you just tell your doctor that you watch this episode, they will just give you Xanax, no questions asked.
yes,
A little bit of a depressing episode today, folks.
but if you look out here, like, equities are doing this is nice. This is risk on. This is we're selling energy, which is good news. So that's the interesting thing to me, is that we're not really giving it up in anywhere except energy. And I was just told that the world was going to freeze all winter, and it's going to be a disaster. So it's very interesting because this is the time where what's going on and what's happening starts becoming two different things, potentially, and that would coincide with our bottom call, because while it looks like things are just getting bad, that means it's ending, and that's what I meant when I.
No time looks worse than the bottom.
Yes, exactly. There's a technical analyst who says when the time comes to buy, you won't want to, and that's that's exactly how it will work whenever it does happen like that. We'll bring out our original analysis and refresh it. Maybe we'll do that. I'm not going to volunteer us for Friday, but if we
I think Friday's good.
Okay,
I'll hold us to that. Yeah, I'll run the numbers on Friday. We'll come back and see if we can refresh what we did on August 19th.
Okay, so you're getting a Cinerat Quant Friday. That's even better.
Well, this means we're going to push housing out then a little bit.
Yes.
Cool. Well, everyone, I think it's time for us to call it. We're at the half-hour mark. I hope you enjoyed the conversation today. We certainly enjoyed having you with us. Thank you, everyone, for joining us. We will be back tomorrow for Stocks to Watch. Now, Stocks to Watch is where we pick out our best ideas for individual tickers that we will be adding to our own portfolios. We are not financial advisors, so please take your own portfolio at your own risk tolerances. And thank you for joining. We will see you tomorrow at around the same time. Bye.